Our learning objective will be to describe the building blocks or concepts of costing systems, to distinguish job costing as a method from process costing as another choice, to describe the approaches to evaluating and implementing job costing systems, to outline the 7-step approach to normal costing, and to distinguish actual costing from normal costing. Our 3 final learning objectives include tracking the flow of costs in a job cost system, how we dispose of an over or under allocated manufacturing overhead cost at the end of the fiscal year and what different alternative methods we have available to us, and then understanding variations from normal costing. So again, we're back with some as reminders of some basic costing terminology just to kind of set the tone for what we're going to be talking about. So be remembered that cost objectives are anything for which a measurement of cost is desired, right? A direct cost of a cost object are costs that are traced to that cost object in an economically feasible way as compared to an indirect cost of a cost object that are costs that cannot be traced in an economically feasible way. And then, of course, in this discussion, we add a couple new terms. This includes the idea of a cost pool, which is a grouping of individual indirect cost items and a cost allocation base in a method by which we can link a cost pool to a cost objective. In other words, how much of which cost would be included with a cost object A versus cost object B. The concepts represented by these 5 terms that we just discussed constitute the building blocks we'll use to design costing systems described in this chapter. And so in cost accounting, we use 2 different types of costing systems, job costing and process costing. In a job costing system, the cost objective is a unit or multiple units of a distinct product or service, which we call a job. Each job generally uses different amounts of resources. And so think of a job cost system as I manufacture yachts. And some yachts may have burled wood, some yachts may have grade A leather seats, some may have grade B leather seats, some may have tinted glass, some may have untinted glass, right? So there are this idea of multiple units of a distinct product or service. So I deliver a $1 million yacht to one person and a $5 million yacht to another. I hope those are going to cost me different amounts to make. In a process costing system, the cost objective is masses of identical or similar units of a product or service. In this type of system, we divide the total cost of producing an identical or similar product or service by the total number of units produced to obtain a per unit cost. And process costing, so think in terms of I manufacture paint and I manufacture millions of gallons of paint each month. I don't use job costing to cost each gallon of paint. I use process costing to determine what my cost per lot is, or chemicals are another good example of that. So these are the 2 different types of costing systems that are in existence. And so here we see some examples of the type of businesses that may use job costing systems versus a process costing system. Remember, the distinguishing characteristic is what is being produced. In a typical job costing system, we are producing distinct units of a product or service, and in a process costing system, we are making masses of identical or similar products. Many companies operate with elements of those systems that are tailored to the underlying operations. And so here again, just very quickly, we can look and see each of the different sectors we talked about across the top: service sector, manufacturing, or merchandising. And then we can see examples across each of those sectors where job costing might make the most sense or process costing might make the most sense. Care must be taken to properly distinguish between the allocation process for actual costing and normal costing. Actual costing allocates indirect costs based on actual indirect cost rates times actual activity. Normal costing allocates indirect costs based on budgeted indirect cost rates times actual activity. So in the sense of normal, what we're doing is saying, well, we're not concerned about what our actual costs are for this particular allocation. We're going to use budgeted indirect costs times the actual activity. But you will see in both cases we're using actual activity. Both methods allocate direct costs to a cost objective the same way, right? One by using actual, one by using budgeted. And so this table summarizes the formulas that are used to determine cost under both approaches. A careful study of the information on this table shows that the only differences are the cost rates used for indirect costs. So please make sure you're familiar with this and that it makes sense to you, and kind of get a good idea of this area or idea of actual costing, which uses actual direct or actual indirect times actual quantities, versus normal costing, which uses budgeted cost. So now we talk through this 7-step job costing process. So we identify the job that is chosen. So that we refer to again as our cost objective, right? We identify the direct cost of the job. We then select the cost allocation base to use for allocating indirect costs to the job. So for instance, that would involve, an example of that would be for factory rent. That's going to be indirect, typically an indirect cost. So we need to decide, well, how are we going to allocate that? Are we going to allocate it per square footage, which might be done? Are we going to allocate it on some other basis? Generally, it's per square footage. Then we identify the indirect cost associated with each indirect cost allocation pool. So when we talk about a manufacturing facility indirect allocation, what are the costs that go into allocating that manufacturing facility cost? Is it rent? Is it property taxes? Is it utilities? Is it janitorial services? Would it include oversight, administrative oversight? And then how do we allocate that out? Again, do we allocate it out based on some square footage determination, or is there some other allocation base that has a more causal relationship, or that can be said to have a more causal relationship between that pool of cost, that is the rent, the janitorial supplies, the utilities, that's the pool of cost, and what they're being allocated out against. So in step 5, we compute the allocation rate, and there we are simply, for budgeted manufacturing overhead rate, what we're saying is we use the budgeted manufacturing overhead cost divided by the budgeted total quantity of cost allocation base. And so that gets us to what we'll allocate out on a budgeted basis across the production quantity in the interim, that is before we get our actual activity. And then we talk about step 6. We use the allocation rate determined in step 5 to calculate the cost that should be allocated to the job. And so there, again, we're saying to allocate cost to the job, we use the budgeted manufacturing overhead rate that we developed in step 5 and apply it to the actual base activity for the job. So we come up with this budgeted manufacturing overhead cost, and then we apply it based on actual activity. And then in step 7, our final step, we add all direct and indirect costs for the job to determine total cost of the job. Remember, direct costs are traced while indirect costs are allocated. And this gets us to the total manufacturing costs. We add the direct materials and direct labor, which are the direct costs, right? And then we add the allocation of manufacturing overhead, which are the indirect costs, to get our total manufacturing cost of that job. And so as we see here, the only difference between actual and normal costing is the way the rates are calculated to allocate indirect cost. In normal costing, we use budgeted indirect cost rates, whereas in actual costing, we use actual indirect cost rates. If we are using actual cost rates, clearly we have to wait until the period year is over to obtain those rates. And so this just gives us a graphical representation of the job costing overview incorporating all 7 steps we just talked about. We have an indirect cost pool, which are all of our manufacturing overhead costs. So that's the pool is where the rent sets, where the salaries for indirect personnel set, where the property tax is set, where the insurance is set. We develop this allocation base, which in this example is determined to be direct manufacturing labor hours. So we come up with a direct manufacturing labor hour allocation by dividing the $1.1 million by the 28,000 estimated hours to get to $40 per direct manufacturing labor hour, which will be allocated to the job, along with the direct costs, which are as we talked earlier, which are not allocated, they're direct. So here we have a broad framework for understanding the flow of cost and job costing. The upper section illustrates the flow of inventoriable cost from the purchases of materials and other manufacturing inputs to their conversion into work in process and finished goods to the sales of finished goods. The lower section illustrates the flow of period cost, marketing and customer and service costs. These costs do not create any assets on the balance sheet because they are not incurred to transform materials into the finished products. Instead, they are expensed in the income statement as they are incurred to best match revenue. So now let's take a look at some of the journal entries we'll use to record each transaction. Our accounting system should reflect as closely as possible the actual state of the business. This allows users of the accounting system to view in the system a representation of what is happening in the business. Manufacturing overhead that is allocated contains all manufacturing overhead costs assigned to jobs using a cost allocation base because, unlike direct materials used and direct labor incurred, overhead costs cannot be traced specifically to jobs in an economically feasible way. And so in journal entry 1, we see that we purchased direct materials. So now in a lot of factories, they have different product lines going on at all times. And so we don't necessarily, we account for it differently sometimes. In this case, we're debiting materials control, which is an asset account, and crediting accounts payable control, which is a liability account. In journal entry 2, we use direct material and indirect materials. So we're pulling materials, both direct and indirect, out of the materials control account and putting them into production. And so in order to do this, we end up debiting work in process control, which is an asset account, debiting the manufacturing overhead control account, and then crediting the materials control because we're moving them out of that control account. Journal entry 3 represents the effect of incurring payroll expenses for both direct and indirect labor. As with the material, the direct labor is debited to work in process control and the indirect labor is debited to manufacturing overhead control. And obviously the cash that's being paid for these is credited. And so journal entry 4 provides an example of an entry for the incurring or recording of other manufacturing costs. In this case, we might have some supervisory salaries, utilities, repairs, or other insurance, that we're recording plant depreciation. And so essentially what we're talking about is we're paying some of our manufacturing overhead, so we're reducing cash account, or we're recording depreciation, so we're increasing the depreciation in both of those. Accumulated depreciation being a contra asset account, which increases with credits, and cash being an asset account, which decreases with credit. And the items represented or reflected in those transactions are items associated with the manufacturing overhead control account, and so we're moving them as a debit into that control account, which is essentially a type of asset account, similar to the work in process account. Journal entry number 5 is recording the allocation of manufacturing overhead to jobs. Remember, these are not actual overhead costs, but represent the allocation. The allocation is calculated by taking the predetermined overhead rate that we calculated earlier based on budgeted overhead cost and budgeted activity level and applying that to the actual activity for the job. In journal entry number 6, we record the transfer of all individual jobs that are completed and transferred to finished goods. So you can see finished goods is obviously an asset account, and so we're increasing our finished goods asset control account with a debit, and we're removing the cost of those products from the work in process control account that we've accumulated all along the way and via our prior entries we've discussed. So when goods are sold, there are two parts of the transaction. The first is journal entry number 7, which we see here showing the reduction of finished goods control and the increase of cost of goods sold. So we're just essentially removing them now from the finished goods inventory asset account with a credit and moving them across, and this is where they literally are moving from the balance sheet to the income statement. So we're moving them onto the income statement via the use of a debit to the cost of goods sold account. So then we have the sales or receivable side of the transaction where we increase revenue and increase accounts receivable, which is shown in journal entry number 9. Note that the sales transaction is recording the selling price and the cost of goods sold transaction is recorded at cost. In journal entry number 8, we record the various period expenses that were incurred during the period. And so these are the items that we had talked about earlier, like research and development cost or marketing expense here or customer service expense. And we're simply debiting the marketing expense and crediting our cash control account. And this is journal entry number 9 that we talked about earlier, where we're increasing the accounts receivable with a debit. It's an asset account, so we've made a sale, we've made it on accounts receivable. If we had made it on cash and they paid us cash for it, there wouldn't be accounts receivable, it would be cash, and we're increasing sales. So you've seen we've hit both sides of the income statement at this point, both the revenue or the sales side and the cost of goods sold or expense side, which the net of those two getting us down to the gross margin line that we talked about earlier. And so this is just a very busy diagram, but it's a visual representation of what we just recorded in a journal entry. And so, you know, it might be a good idea to freeze your presentation and to using one, for example, at the top under General Ledger we see the one circled, and you can see the journal entry associated with the purchase of direct and indirect materials, so of $89,000. So if you go under materials control, we can see the debit side of that is the materials control, and so we made a purchase, we made it on credit, assuming we made it on credit, and the other side is a little further down from the materials control and the accounts payable control, where we have the credit side of that entry as a 1. So the circled ones represent the debit and credit side to the T accounts that are represented here. And again, this kind of walks us through these transactions with respect to how they move from and through the income balance sheet to the income statement. So freeze your screen if you would, and just take a little time and kind of walk through this to make sure you're comfortable with this based on the journal entries. These are the 9 journal entries we just went through and how they're reflected in the T accounts. And so illustrated here is a subsidiary ledger that contains the underlying details that help managers keep track of a particular job. The materials record is used to continuously record the quantity of materials received, issued to jobs, and the inventory balance for each type of material. The labor records are used to trace the cost of direct manufacturing labor to individual jobs and to accumulate the cost of indirect manufacturing labor in the indirect manufacturing overhead records. Panel C shows details of different categories of overhead costs such as indirect materials, indirect manufacturing labor, supervision and engineering, plant insurance, and utilities and plant depreciation. So you may recall that two different overhead accounts are used in our journal entries for overhead-related transactions. We use manufacturing overhead control for the actual overhead costs incurred and manufacturing overhead allocated for the estimated overhead applied to production through the work in process account. And so for numerator and denominator reasons explained earlier in the chapter, under normal costing, a company's actual overhead costs incurred each month are not likely to equal its budgeted overhead costs allocated each month. The difference is identified as an over or under allocated methodology. So just keep in mind that if overhead control is greater than overhead allocated, this is called an under allocated overhead. So what that's saying is that if we said, well, we're going to allocate based on budgeted cost 50 cents per hour to per manufacturing hour to a particular product, and our actual overhead came in at 75 cents per hour, we've under allocated overhead. And then the opposite is true of the overhead control is less than the overhead allocated. That we would call an over allocated overhead. Right? We've allocated more to the product when our actual costs were coming in at less than what we had budgeted. So our products are bearing a greater cost. We've over allocated overhead to them. And so under allocated indirect costs occur when the allocated amount of indirect costs in an accounting period is less than the actual incurred amount. Over allocated indirect costs occur when the allocated amount of indirect costs in an accounting period is greater than the actual or incurred amount. And so then the next question logically would be, well, what do we do with these differences? So we use three methods to account for the over or under allocated overhead. As you can see here, we can use an adjusted allocation approach where the allocations are recalculated with the actual rate. That's a big deal if you think about going back and recosting every transaction or every allocation for the year again based on actual. Or we can use a proration approach where the difference is simply allocated among cost of goods sold, work in process, and finished goods based on the relative sizes to one another. Or the third approach is simply to write off the approach where we just write off this difference to cost of goods sold, and that's generally where this difference is immaterial. So we have three approaches or three ways to handle the over under applied overhead. And this becomes a management decision, and it does open the door for some more discussions with respect to how we can manipulate ending inventory and thus our cost of goods sold in the next period, but we won't go into those right now. Here we see several of the factors that should be considered when choosing among these approaches. So we include the purpose of the adjustment, the size of the amount, that is how material it is, and whether the variance was over or under allocated. And we should be, there is some guidance to help us in making that decision, and we should keep in mind issues like materiality, consistency, and industry practice. And so job costing is just as appropriate in the service sector as it is in the manufacturing sector. If the actual direct labor costs are difficult to trace to jobs, these costs can be allocated using budgeted rates instead. The mechanics of using budgeted rates for direct costs are similar to the methods employed when using budgeted rates for indirect costs in normal costing. And so this concludes Chapter 4 on job costing. I hope you found it interesting. It's an important area, having this sound understanding of job costing versus process costing, having a sound grasp of how costs flow through the balance sheet to the income statement, and a good grasp as accountants of the journal entries that are reflected via that flow. And then, of course, what's important when it gets to this idea of over versus under allocated, and how might abuses of that impact the income statement and thus performance implications. Please go back and reread the chapter. As usual, I'll remind you not to take this presentation as a substitute for reading the chapter. And with any questions or comments, please don't hesitate to contact your facilitator. Thanks very much.